Good morning and a happy pre-holidays to all of the investors and traders around the world, to our Finom group members. Haven't done a video in several weeks now. So I figured I'd give us all an update, give us all maybe an outlook as to where the market is going into the end of the year, possibly even early 2024, thinking of January. Um, Hope everybody has had a good investing and trading year. I know the market has had a robust rally through the course of this year. It hasn't been in a straight line. We had a mid-year correction, 10% on the S&P 500, a good 14% in the NASDAQ, which is more highly concentrated, so it tends to deliver bigger moves. But as the calendar turned from October to November, we've seen a robust rally in the markets. We've seen a broad market participation that includes equal weight, small caps, which have been the laggard of the year. And I don't anticipate small caps doing any meaningful catch up, but nonetheless, all this breadth in the market that has taken place as the calendar turned into November has delivered with it the second Zwig breadth thrust of the year and a second Whaley breadth thrust. Don't discount these breadth thrusts, folks. For those of you who have watched our Finom group videos in the past, you've heard me talk about the Zwig breadth thrust and the Whaley breadth thrust and how we use these when we are engaging the markets and for practical purposes with our portfolios. One of the things that I've often said when it comes to a Whaley and a Zwig breadth thrust is these are buy the dip signals. When you get corrections in the markets after you've had these kinds of breadth thrust, historically, they have a 100% probability of delivering themselves as opportunity to buy the dips for future returns. So with that being said, a lot of the content that we're going to go over here today has already been delivered to our Finom group paying subscribers this past weekend in our macro market research report. And as always, if you are not a member and you don't receive our exclusive content, folks, treat yourself to a holiday gift. Become a contributor membership. You'll get our macro market research reports, our state of the market, and our third-party research each and every week. If you would like to understand our trading and our investing ideas going forward, participate in our Telegram as well as our live daily trading room, become a premium membership and have all access, if you will. All right, so key investing data into and through year end 2023. Yeah, we're almost there, folks. We're almost at the finish line, as they say. This was a great graphic that Michael Antonelli, a friend of Finom Group and a friend to investors, he's the chief equity strategist at R.W. Baird, one of the biggest investment research shops in the entire nation, North America. Just always has a good outlook and a good discipline when it comes to investing and engaging the markets. If I was to describe Michael, I'd say he's optimistic, glasses always half full, and understands that you have to have a good you have to have the people around you facilitate that kind of posture when it comes to investing. And earlier this year, he came up with this graphic basically denoting the various firms and individual investors or portfolio managers that are of like minds when it comes to engaging the markets as an investor, managing funds. Here's Finom Group right there. So, I'm honored to be included in, the class of these different individual investors, media, elite, if you will, and fund managers. All right. So with that, I asked the question, how did this all begin, right? Well, S&P 500 is up 19% year to date. The NASDAQ is up some 37% year to date. Well, early on in the year, when we're following different seasonality data, seasonal data or patterns, the January trifecta fired bullish. What is the January trifecta? Well, that is a condition for which the market has delivered positive Santa Claus rally gains. The first 5 trading days of the year are also positive. And the January barometer, which is basically the return for the month of January, was also positive. If you get those 3 things happening, we call it the January trifecta indicator. Now, it's one thing when the January trifecta happens. Generally, the full year returns are double digits on average. And historically, I think it's happened 31 times. 28 of those years that you've had the January trifecta, the market delivered a positive return. 3 times it did not. So what am I showing you here in this graphic that says 13 positive signals and no negative return years? Well, this takes the data that much further. This is an occurrence where you've had the trifecta after a down year. So a bear market in the prior year, then you deliver a January trifecta. The market has never delivered a negative return when we heighten the criterion for the data. You say, Seth, well, you can say that now. How do we really know that, this is what you discussed with Finom group members at the end of January or going into February? Again, that's the benefit of the Finom group platform. On February 5th, which was the first research reports, after the month of January concluded and we had all the data in hand, I said, look, we're going to get a pullback, folks. It's just a matter of when and how deep. But don't worry. Be happy. Why? Because we had several breath thrusts taking place in the month of January. And we had that January trifecta. So if you scroll down, you can see, indeed, trust but verify, as they say. Indeed, we talked about the breath thrust, and here is that bear market prior year followed by a January trifecta. All right, moving on. So that's how it started, and then we got to basically mid-year, the end of July. By the end of July, the market was up some 19%. And before we had a pretty significant correction that may have shaken folks out of the market. It happens quite often. With that being said, here was a data point from Ned Davis Research, again, that we disseminated, in July and August regarding what may have taken place. At the end of August, the month was down. We had a down month for August. So what happens when January through July delivers a greater than 10% return and August delivers a negative return? Well, historically, starting September through the end of the year, the market has never delivered a negative return, right? There's no negative symbols in front of here. The median gain from that September through end of year date or time period is 8.7%. The median gain, right? Now coming into November, right? A 3-month long corrective period. A lot of folks got disheartened. A lot of folks were selling. A lot of folks gave up on the market. They're listening to the financial media headlines. We see what's going on with our domestic politics, geopolitics. We've got an OPEC meeting ahead. We had the possibility of a government shutdown. I mean, folks, the headlines are never going to lean in favor of you allocating more capital. They're usually pessimistic, negative, cautious, offering all kinds of warnings. So what we wanted to do was center ourselves, right? Get our emotional quotient in check to make sure we're following the data. And this data point told us you need to remain optimistic. we need to understand historically, human behavior doesn't really change when it comes to engaging the price action of the market. And that's why this data was so compelling. 100% probability that by the end of the year, the market will have a positive return. Now, this weekend, I was looking at this particular data set once again, and I said to myself, well, from the end of August, right, 8/31, the S&P 500 was at, I think it was 4507. Fast forward to the end of last week, right, Friday's close, the S&P 500 was 4514. We've gained 7 points in the S&P 500 since the end of August. And then I went and I looked at this column again and I said to myself, wait a second. That's a lot of upside potential here if the median is 8.7%. But that, when do we get the median, right? Do you see the median anywhere delivered here? No, right? We rarely get the median. We rarely get the exact average return. So I look at worst case probabilities. In the worst case, the market from September through the end of the year, given this criterion, was only up 3%. That was the worst case scenario. But as of last Friday, we were only up 7 measly points. This told me that the probability for rapid upside, from last Friday's close to the end of the year was pretty darn good. If this is going to deliver the worst case scenario, we still had 3% upside at a minimum. At a minimum. To visualize this data more concretely, that's what I did. I took just the gains from August 31st through December 31, highlighting the worst of it. That's the worst we could do possibly, unless there's going to be an outlier year, right? I mean, there's always that possibility, but we live in a world as investors of probabilities. Anything's possible. There's nothing you can do with possibilities, right? The world could end tomorrow. That's possible. There's nothing for me to do with that. As investors, we lean into the probabilities that help us to guide our capital allocation decision-making. So, folks, what do you know? First day back, first day this week in a holiday shortened trading week, market was up 1% yesterday. Again, going back to the middle of the year, June, I looked at this chart here. This is from one of my Twitter posts that was also in our macro market research report. I was looking at the 5-year weekly chart. And man, that trend line looked beautiful. But what was most important, right? Most important, they don't get much more telling than this. When you clear, right, this congestion zone, support, break through a bit, but pretty much come back, get above support, come back, breaking down here in 2022, forming what might be a cup and handle, and then you have a really nice convincing breakout. Folks, any pullback equals great opportunity. So what happened? August through October, we had a great pullback opportunity. It's about, when you have convincing breakouts, you have to have conviction as an investor. Remember the breath thrust from earlier this year. The market knows. The market doesn't care about your headlines. It doesn't care about your what ifs. It doesn't care about your yeah buts. The market knows. That's the benefits of technical analysis, and these are the benefits of quantitative analysis. That being said, did you take advantage of that pullback, right? Folks, yesterday, now at Finom Group, we've studied, we understand, we utilize one of the most compelling of quantitative studies in history by the most famous of quantitative analysis analysts in history, Wayne Whaley. And it's called the Toy Barometer. In this past weekend's research report, we talked about the Toy Barometer. Why? Because it started this Monday, yesterday. What is the Toy Barometer? Well, Wayne Whaley basically wanted to better understand mathematically, what period of the year lends itself to forecasting forward 12-month S&P 500 returns. And what he found, he put all his data into the computer and it spit out, the best probability. And that is how he defined the Toy Barometer. The Toy Barometer starts on November 19th. If it's a weekend, you start the following Monday, which is what happened this particular year. So the Toy Barometer for this year starts on November 20th, and you're looking at last Friday's close, which again, 45.14. That's your starting value, and your starting date would be November 20th. And it runs through January 19th of the next year, January 19th. So it's basically looking at 2 months worth of price action. Historically, if you gain 3% or better over that 2-month time period, S&P 500 returns are extremely bullish over the next 12 months. Again, the criterion: a bullish toy signal will fire if you gain 3% or greater from that November 19th to January 19th period. Why is it called the Toy Barometer? Well, it's the seasonal time of year. It's the gift giving. It's the seasonal time of year. But also toy stands for, or is an acronym for, turn of year. Historically, this chart is not updated. This table is not updated. This is the S&P 500 performance after a bullish toy barometer, meaning that it, these particular years gained 3% or greater. I'll blow this up a little bit here. Historically, we've had actually 37 bullish toy barometers, right? The last one being 2021. And we've had 35, because 2021, we all know the S&P 500 was up 25% that year. We've had 35 positive 12-month forward returns in the S&P 500. Only twice was the S&P 500 down in the next 12-month period after a bullish toy signal. Those 2 years, you might have guessed, 1987 and more recently 2018. So you have a 96% probability, 96% probability the S&P 500 will deliver positive returns on average. What is the average also, which is quite compelling? The average return, 16.5%. The median return, 15%. Again, when you have probabilities this high, you want to pay attention to this kind of seasonal and quantitative studies. Now, what is the probability, right? What's the probability that we'll have a bullish toy signal? Well, use this data here first and foremost, right? Remember, we were only up 7 points coming into this week. And historically, through the end of the year, from August 31st to December 31st, the minimum was like 3%. So there's a high probability that this first half of the toy period, the toy barometer, could be quite compelling, quite bullish. What about the January, right? What about that January 1st through January 19th period, right? The back half of the toy barometer, those final weeks, if you will. Well, here's some data that our Finom group members remember very well. Now, coming into this year, right, coming into 2023, I said, and I even posted to Twitter, or as it's known, X now, I said there's 100% probability that January will deliver a positive return simply by looking at this data. The January barometer hasn't been as accurate lately. This is a former graphic or quantitative data from LPL research. Now, at face value, you're like, well, how did you determine that, Seth? I mean, these are just posting the years that it was actually a positive year after a negative January. I saw a pattern developing within the particular years. So check this out. And again, some of you have seen this before. I know our Finom group members remember this from earlier this year, or actually, it was part of our Outlook report on the final week of December 2022, giving our outlook for 2023. With that, what I noticed starting in 2008, right, because this didn't fit the pattern that I found. Starting in 2008, you have 2008, 9, 10, all down Januaries, right? 2008, 9, and 10. These are down Januaries. Well, where's 2011, 12, and 13? It skips to 2014. Again, these are just down Januaries. That's what's listed here, down Januaries. So that must mean 2011, 12, and 13 were positive Januaries. So what do we have here? 2008, 9, 10, negative Januaries. 11, 12, 13 were positive returns in January. Now check it out. 2014, 2015, 2016. 3 more negative years. So you had 3 negative years followed by 3 positive years for the January return, followed by 3 negative years for the January return. Where's 17, 18, and 19, right? You're already ahead of me. Not there. Why? Positive, positive, positive. 3 more positive years. And then what happens? 20, 21, and 22, as we know, 2022 was also negative. 3 more negative years in a row. So I saw the pattern. 08, 9, 10, down. 11, 12, 13, up. 14, 15, 16, down. 17, 18, 19, up. 20, 21, 22, down. If this pattern repeats, that would mean 2023 starts a 3-year cycle of up Januaries. And lo and behold, 2023 was up for the January return, which points to the probability based on this cyclical pattern that 2024 will be year 2 of the 3-year up January returns. So again, how do we know the probabilities for the toy barometer? Right? We know we came in with only a 7-point gain with, basically only 6 weeks to go into the end of the year. And based on this data, it suggests the first half of the toy barometer should be positive and deliver a good return. And based on this seasonal data, it says that January has a high probability of also producing a positive return. Folks, we're looking at a toy barometer that has a high probability of delivering a bullish signal. And you know what that means for the S&P 500 returns over the next 12 months. It's compelling, isn't it? But, that's from study. You got to study. You got to have the right resources around you. And again, if you're not a member of Finom Group, go get your subscription today, folks. Because these folks aren't going to help you out. David Tepper is leaning short on the stock market into 2023. Headline, December 22nd, 2022, right? Big fund manager, Appaloosa, David Tepper leaning short on equities. Liz Ann Saunders, December 22nd, 2022. Here's your Christmas gift, investors, right? She's contemplating a back-to-back down year in the S&P 500. Fast forward, right, to let's see, I'm not sure. This was probably late October from Mike Wilson of Morgan Stanley, one of the most bearish Wall Street strategists. He says Morgan Stanley's Wilson sees year-end stock rally as unlikely. How's that working out for you? Knock on wood, right? We don't want to jinx things, so to speak. They're not going to help you in your bullish endeavors, folks. They're not going to make you feel comfortable taking advantage of corrections or dip buying opportunities. Just this last weekend, Jim Chanos shutting down his hedge fund, right? The world-renowned, the greatest short seller of all time is shut. Now, last year, I warned people about Jim Chanos because we happened to be in the stock that we were long and he was short. And I was telling our investors, look, this is what the financial media or how the financial media characterizes this people are far from the reality of how they perform. Jim Chanos went from some $6 billion under management in 2008 down to $200 million. That doesn't happen because you're outperforming. That doesn't happen because you're market performing. It happens because you're underperforming consistently and forever. You know, when people say he's the greatest short seller of all time, good, fine, great. He's the greatest compared to his peers. What it tells me is that's a job not worth doing. The greatest short seller of all time basically has to close up his shop because he underperforms historically. Just this last week, I mean, this is how I know, investors just were not buying the dip. If anything, they were selling. Fear gripped them because of these folks, because of the headlines, because of this bearish attitude, because of the negative sentiment. Retail investors sell off U.S. stocks at fastest pace in years during the month of October. So basically at the trough of the corrective period, retail investors were selling. 2 weeks ago, folks, November 10th, I posted this chart, this breakout of the triple Qs, the NASDAQ 100 ETF. What has happened since the S&P 500? Well, the S&P is up another 2+%. The NASDAQ is up nearly 4% since November 10th in this breakout here. We talked about this quantitative data earlier in the year when the NASDAQ 100 made a 52-week high on May 18th. The data told us, I'm looking at percent higher going forward. What is the probability after hitting that 52-week high that the NASDAQ 100 is going to keep delivering positive returns? Looking out 6 months, which takes us basically to the end of this year or where we are today, there was an 85% probability that the NASDAQ 100 would be higher than the 52-week high date. Lo and behold, it is. 12 months later, it's never delivered a negative return. Lean into the higher probabilities, folks. This chart right here kind of emphasizes the NASDAQ 100 hit, well, here it was within 4% of the all-time high. I guess that's November of 2021. So I went back to 1987, which is the NASDAQ 100's genesis when it was first formed, 1987. Not a good year for an index to be formed. But, since 1988 and after the NASDAQ 100 has been in a bear market, if it's climbed to within 4% of its all-time high, it has gone on to make all-time highs every single time. It's just a matter of when. Last but not least, we had a 90% up volume, up issue day on November 14th. And what this data from Bank of America research tells us is that there's a high probability that if we go out, some 2 months, 81% of the time, the market is still delivering positive returns. With that, hope everybody has a fantastic holiday season. Join us here at Finom Group. Get all your weekly research. Take care, everybody. Drive safely to your holiday engagements and be with friends and family. Take care, everyone.